Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 132 on September 19th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Norwegian Cruise Lines, the United States Oil ETF, and General Motors. And then we discuss three new trades on Sorrento Therapeutics, Plug Power Inc., and Kinross Gold Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets had another week of relatively unchanged results. The Dow Jones Industrial Average closed the week at 27,657 points, down 8 points. That's next to nothing. And the S&P 500 index lost 21 points, ending the week at 3,319 points. Now it's time to talk about the topic of the week. And the topic this week is kind of the beauty of looking at the world through the lens of options. So each week, and even in my own life, I focus on understanding risk. And there are opportunities out there that can have like a high perceived risk and high rewards. And I was recently looking at an asset, really in the cryptocurrency space, that operates as an inverse derivative. Basically, when the base asset goes up, this other asset I was looking at declines in value, and vice versa. It's like one of those short or ultra short ETFs that is traded. Like the S&P has a couple of short or ultra short indexes, ETFs that go up when the S&P 500 goes down. So now, one of the things that made this one sort of tricky, one additional glitch, is that it has an upper and lower level boundary. That means when the price of the inverse asset goes high, the asset cashes out. And likewise, if it goes really low, the asset cashes out. So if you use this asset as a hedge, you have to reevaluate the hedge when it cashes out. So when it either hits too high or too low. And, that's really tricky for a lot of people. But again, I'm an option trader. And as I thought through the complexity of this asset, it dawned on me that this is nothing more than a put option with double barriers. See, years ago, I used to help structure exotic derivatives at Merrill Lynch. I used to work in Merrill Lynch's energy trading group in Houston. And we often would have to model out the various dynamics and payoffs of structures like this one, to make sure that we truly understood the securities that the index desk wanted us to create and offer to different clients. So as complicated as it can all seem, it still just gets back down to understanding the risk of the position at various points, meaning at various prices. At this price, this is what that asset is worth. At this price, this is what it's worth. So if you can model it out based on where the price is going to go, you'll actually start to understand how it's going to make or lose money for you, and then you start to understand risk. So, as complicated as it can all seem, like I said, it's back down to understanding your position. This week, I was quickly able to become comfortable with the idea of using this asset, which acts like an exotic derivative simply because of my comfort with option trading. It always gets back to calls and puts. Just like in football, it always gets back to, blocking and tackling. Like, keep it simple. If you understand the basics, you'll be able to handle the most complex positions out there that might be considered really risky or even considered, really difficult. If you can break down your complicated or confusing or however messy a position, and God knows I've had some really messy positions in my life, uh, both personally in my own accounts and corporately, at work. And sometimes you just have to sit back down and pull out a piece of paper and go one by one, option by option, line by line, and understand what's going on. Doesn't matter whether you're dealing with an exotic derivative or a book of vanilla options, which I would imagine most of you are using vanilla options. It all just gets back down to, do you understand the individual risk of each option that makes up the position? So no matter how complex, it all just gets back down to being simple. And if you understand options, you will see the world differently, not only in trading, but I look at, I bought a car recently, and, the various warranties that they offer are nothing more than options. I mean, look, there's the insurance that they're offering is really an asset that is going to offer or increase in value if I have a negative incident on my car. It's a put option, right? And then there are timelines, so it has an expiration just like my options. It has a strike value of the because of the value of my car. So there are a number of things in the world that relate back to option trading. At least they do for me. Maybe I'm crazy. Maybe you're not crazy and you should run. But but you start to see risk through a different lens, and that's the beauty of option trading. So let's dive into review from last week. So as usual, we'll start off with the covered call. We looked at Norwegian Cruise Lines, symbol N as November, C as in Charlie, L as in Lima, H as in Hotel. At the time, the stock was trading for $17.51 per share. I looked at buying that stock and selling the October 20 call at $1. We were hoping for a maximum return of 19.93%, almost 20% in 5 weeks. Well, Norwegian Cruise Lines stock fell $1.26 per share this week, closing at $16.25 per share. That is slightly below our break-even point of $16.51 per share. So that gives you some additional things to think about right there. But the call option we sold fell 57 cents, leaving us with a net loss of 69 cents on the trade. So the standard response to a loss on a covered call is simply to roll the strike lower. That would mean buying back the October 20 call and selling the 1750 strike in October. If we did that, we would collect 97 cents for selling the October 17 half call and turn our current loss of 69 cents into a current profit of 28 cents. We would also be lowering our maximum profit down to $1.53, or a total of 8.73% return on our initial capital. So that's not bad for starting off in a loss and still being able to possibly position yourself for a profit. And I pointed out earlier that we are below the break-even point, because if you want to stick with that hard and fast rule, you'll take the 69-cent loss and then go ahead and look at another position, look for another trade. You would do that by selling out the stock and obviously buying back that call option that you sold. Our next trade from last week is the credit spread. We looked at the United States Oil Fund ETF, symbol USO, U as in uniform, S as in Sierra, O as in Oscar. At the time, the stock was trading for $27.04 per share, and we looked at selling the October 28-29 call spread at 34 cents, which gives us a maximum possible loss of 66 cents per spread. Well, USO stock actually grew $2 this week, $2.02, closing at $29.06 per share. Our out-of-the-money call spread that we sold is now in the money, so this is a loss. The spread can be repurchased for 75 cents, which creates a loss of 41 cents per spread. And we know that our maximum possible loss is 66 cents, which means there's another 25 cents that you can lose in this. Now, I like selling a put spread against the short call spread to offset some of the loss. It's important to choose one with lower strikes as well, lower strikes than your call spread. So before we make a decision, I like to look at the stock chart just to get a better sense of where the stock appears to be heading and where it's been. So the past few days of upward movement may lead to higher prices indeed, but and that would mean that our call spread could still lose another 25 cents. But I would also look towards whether or not to just close the trade, or if I think the spread will head back out of the money, meaning the price of the ETF might go back down. Now, the price is above the break-even point of $28.34. And I'm interested in selling a put spread against the call, but first I would lean towards waiting a day or so to see if the stock is going to continue to push higher or if it's going to head back lower. That will give me more confidence in selling higher valued puts. It will also give me an idea of whether or not to close the call spread or to let it go, let it ride. Meaning if the price of the ETF went ahead and fell on Monday and continued to fall, I might be a little more, I might lean towards not closing this trade. And I also would be more hesitant to sell a put spread. Either way, at best, you'd be lowering the loss sustained this week, unless the price really does go back below our break-even price of $28.34. Now, you really need to understand the risk inherent in the new position as well before altering the trade. For instance, if you were to sell the October 28-27 put spread, you'll collect 20 cents. That cuts our loss on the week in half, right? 'Cause right now we're at a 41-cent loss. So if we collect 20 cents, our loss is only 21 cents. It even lowers our overall risk to 46 cents rather than the total of 66 cents possible when we put the trade on. But it also essentially guarantees a loss on the trade unless the stock finishes right at $28 per share. So it's always a trade-off, right? I'm more prone to wait to see if this stock is going to give me any indication of which direction it's going to go. And I would have no problem, let's say the stock does end up going up, I'd have no problem closing this trade because I know that this in the money trade, if stock goes higher, it's going to expire being worth $1, right? So that's a known quantity. So since we know that there's another 25 cents possible loss in this trade, I don't want to make a decision that's going to lead to another loss. So let's say I say, okay, well, I'm going to just close this trade, take the 41-cent loss, and I'm going to turn around and sell a call spread and a put spread. That's so that the premium on both sides is going to be greater than my 41 cents. That's great, but if the stock continues to rally, you're going to be in position to lose another 50 to 60 cents on this spread. So, or on this name USO. So I just want to be cautious and get you guys also to make sure you run through various scenarios. Look through every scenario before you make a decision on a loss or a win for that matter. But definitely on a loss, because you don't want to turn around and do something that seems to make sense and all it does is create another loss or put you in a scenario where there really is no win unless you are truly able to, like if I sold this October 28-27 put spread and we've already sold the 28-29 call spread, we need the stock to finish right at $28 in order to be able to make a profit. Otherwise, we're definitely going to lose more money on the trade. So it's not worth it. Oftentimes, you can look at the 27-26 spread, but that's trading for much less money. It's like 13 cents, I think. So either way, something to think about, something to look through. But these first two trades of the week did finish in a loss. So 2 out of 3, which I guess is a little bit of foreshadowing for our debit spread review. We looked at General Motors, symbol G as in golf, M as in Mike. The stock ended the week, or actually last week when we looked at the trade, the stock was trading for $30.46 per share, and I bought the October 29-30 call spread for 64 cents, which gives us a maximum gain of 36 cents or max return of 56.25% over the next 5 weeks. Well, GM stock grew $1.04 this week, closing at $31.50 per share. The in the money call spread we purchased is now even more in the money. If you were to close the trade, you would close the trade for roughly the same price that we paid to enter it. But we know that this trade is going to be, it's even more in the money now, so it's much more likely to expire at its maximum value of $1 per spread. That will lead to a gain of 36 cents, or that's the 56.25% return on your capital that I mentioned in another 4 weeks if stock prices remain above $30 per share. So that one worked. Hey, I'll take at least, I've had losses of where 3 out of 3 trades lost, and I've had wins where 3 out of 3 wins. So in a week where I get 2 losses and 1 win, I'm happy. No adjustments are needed on this trade. Sure, stock price has been going up. You can get fancy and sell a put spread against this just to collect some more premium. If you do that, I would still caution against selling strikes higher than 29, just because you never want to be in a scenario where that call spread triggers, like if the price goes down, you'll lose money on the call spread and the put spread at the same time. So all in all, you can make things more complicated. There are always ways to make it more complicated, or you can just, keep simple and be happy with the gain on this one. So let's get into the new trades. And before I start, of course, yesterday, September the 18th, was options expiration. So all of your September positions either finished being worth their intrinsic value, or they are priced at zero today. So hopefully you guys wrapped up any September trades and are smiling today. The beauty of trading options, it's like having an exit event every month, right? So I like celebrating exit events with my friends. I have friends who are in private equity or have done some venture capital or even just bought businesses or started businesses. And, when they sell their business, normally it's a good day. Even if they're not selling it for, 5 or 6 or 8 or 10 times the value of the company, they do oftentimes end up at least getting a cash reward for their investment with some return on top of that. Plus, they've earned income over the years. So whether they get everything they want or not, I say let's celebrate exit events. And option trading is like getting an exit event every month. It's fantastic because, hey, I think we all need reasons to celebrate even more, especially in the year 2020. I look forward to 2020 being in hindsight, as I'm sure many of you do too, but it's actually been a pretty good year for me on some levels, and challenging, obviously, on many others. So let's get into the trades on this week. We're going to start off with the covered call, looking at a company we looked at back in June. It's called Sorrento Therapeutics, symbol SRNE, S as in Sierra, R as in Romeo, N as in November, E as in Echo. The stock ended the week at $9.43 per share. I'm looking at buying stock and selling that October 10 call at $1.70, hoping for a maximum return of 24% in 4 weeks, which is pretty good. You enter this trade by buying Sorrento stock for $9.43 per share and selling that October 10 call at $1.70. This trade makes the most money if stock prices finish above $10 per share, and the break-even price is $7.73 per share in that stock. In real terms, the stock purchase would require $943, and you would collect $170 for selling the option. And what I love about this trade, in case you guys are out there looking for other similar trades, it's the high value, the high amount of premium that we're going to collect for selling that call relative to the strike. And what's different about this trade compared to last week's trade, last week we would have needed, we were selling the October 17 half call, and we were buying stock at $17.51, but we were selling the October 20 call, which means that we actually wanted stock to rise $2.50. Here in this scenario, for our maximum return to happen, we only need stock to go up 57 cents. Even if it doesn't, as long as it stays higher than our break-even price of $7.73, you'll finish this trade making a profit because of the high amount of premium that you're collecting on that call option. So that's what I look for in a lot of these call options, these covered call strategies. So you can keep an eye for other opportunities that you might run across. And if you see something worth discussing on the show, feel free to email it to me. Next, we're going to look at a credit spread on Plug Power Inc., symbol PLUG, P as in Papa, L as in Lima, U as in Uniform, G as in Golf. The stock ended the week at $13.56 per share. I'm looking at selling the October 13-12 put spread and collecting 36 cents per spread, which can also give us a maximum possible loss of 64 cents per spread. Now you enter this trade by selling the October 13 put at $1 and concurrently buying the October 12 put for 64 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices remain above $13 per share. The break-even price on this is $12.64 per share. And in real terms, you would receive $36 per spread that you sell and have $64 per spread at risk. And our final trade on the week is going to be a debit spread. I'm looking at Kinross Gold Corporation, symbol KGC, K as in Kilo, G as in Golf, C as in Charlie. The stock ended the week right at $10 per share, and I'm looking at buying the October 9-10 call spread, paying 66 cents per spread, and that can give us a maximum gain of 34 cents or 51.5% return in 4 weeks. Now you enter this trade by buying the October 9 call for $1.24 and concurrently selling the October 10 call at 58 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices remain at or above $10 per share. The break-even price on this is $9.66 per share in the stock, and in real terms, you will pay $66 to enter the spread, and your maximum gain is $34 per spread. So that's it for the trades for this week. Thank you guys so much for listening to the show. My numbers continue to grow, and I really appreciate that. So thank you guys for sharing this with people, with friends of yours who also love options and option trading. If you ever have any questions, like I said, feel free to email me. And I love getting the emails from those of you who do reach out to me. Some of you crack me up. Other times you have some real challenges, and I love being able to walk you through that. So thank you once again. And I hope you have a wonderful weekend. And as usual, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.